All right, cool. Let's talk about Grab. So Grab had earnings yesterday. Obviously, this is a stock that I am pretty bullish on. My price target has been $10 by 2027. I feel like I've reiterated that many times. However, based on the retail mania that I still don't know how to explain how it happened over Sunday, people are expecting $10 after earnings. And those people, quite frankly, they're probably disappointed. Those people deserve to be disappointed and leave the stock, because I think for the majority of us that are in the Grab community, which is a good 10, 15 of us on Twitter that actually like really talk about it. I think all of us knew that, hey, this was going to be a quarter where we needed to see execution and it would get us back to the trajectory of where we think Grab can go, which for most of us is $7 to $10, $7 by the end of this year, $10 by the end of 2026. And that's what they did. They put up a hell of a quarter. There were a couple metrics that we'll talk about that I didn't like, that I think eventually can be fixed in 2025. But that's what they did. And the stock got punished down 11%. Where are we at right now on Grab in the pre-markets? We're back at 519. All right, so we got a reversal from about 465 to 519. I have no idea at 930 how that's going to hold up. I could see it going back to 475. I could see it gapping back up to 530. We'll talk about the analyst upgrades we got on the name today. But it was a good, not great quarter. And so I'm ready for the stock to either go up or down, because, I mean, it's not one of those quarters like Robinhood was a quarter where like that stock deserves to be up 20%. Same thing with Palantir. This one, it definitely doesn't deserve to be up 20%, but it definitely doesn't deserve to be down 20%. So we'll see how the street interprets it. $764 million in revenue. They beat on revenue 17% year over year. $97 million adjusted EBITDA. That's an all-time high. GAAP profitable 2 quarters in a row. I was really happy that they are getting to the point where they can sustain GAAP profitability. Positive adjusted free cash flow. They guided for $3.4 billion of revenue, which is 22% year over year growth. Financial services up 38%. Their loan books up 64%. They bought back 10 million shares, and their monthly active users are now 44 million. That is about 6% of the entire population in Southeast Asia. CEO said fourth quarter was our strongest quarter ever. We finished 2024 with on-demand GMV growth accelerating to 20% year over year as we continue to generate profitability at scale. We have more users on our platform than ever, and our unique platform advantages places us in a strong position to continue this growth momentum into 2025 and to deepen user engagement across our entire ecosystem. So why was Grab down? Well, it's actually very simple, and let me pull up the report right here. Their adjusted EBITDA margins as a percentage of GMV. Remember, Grab is a business that it generates a ton of GMV, which turns into revenue, but then they have to take a certain amount of that GMV to become profit, and that depends on their margins. So if we take a look at this right here, the only reason that I think the street is giving them a little bit of pain, there's actually 2 reasons, but this one is the first kind of big reason. They are not diluting heavy. They're actually buying back the same amount that they're giving in stock-based comp, so it's kind of a wash. As you can see right here, segment adjusted EBITDA on deliveries is only up 1% year over year. That's not good, right? That needs to go up significantly more, because it's showing that you don't have pricing power, or you don't have the ability to excel your margins, which is why the Grab GoTo merger is so important, because if they can get rid of some of their competitors, they can stop having a race to the bottom, which is what's happening in Southeast Asia with some of these ride hailing and delivery apps. And so that's only up 1% year over year. And then their segment adjusted EBITDA on mobility is up 19% year over year, 153 versus 128. But the percentage of segment adjusted EBITDA of GMV is down 0.3% year over year at 8.4% versus 8.7%. So you might be thinking this is a little bit nitpicky, and it is. But at the end of the day, investors really want to see these low margin businesses get to higher margin businesses. Financial services is a much higher margin business, but that's still negative on segment adjusted EBITDA, which I think will turn positive by Q3 this year. And as long as they get those margins up, Grab can start getting rid of the narrative that the company doesn't have a moat. Because I'm sympathetic to people saying they don't have a moat because they have this big network, but they can't get the money out of the users, and they're spending way too much money in terms of incentives in partners, consumers, etc., to get people on the app. This is what Uber did back in 2010. They would give you like 10 free rides just to get you to use Uber over Lyft, which meant Uber lost a lot of money for a decade. But once they got everybody onto the platform, you weren't going to leave. I think that's basically what Grab is doing right now. The question is simply, how strong can that strategy be over the long term in order for them to win at developing their network effects, which I think they will do. And so that's why I thought the 10% sell-off last night was like a little, just a little bit aggressive for no reason. I understand why investors are mad about that, but I don't think that's a reason to say the thesis is broken. And if anything, guiding for how they're guiding in terms of top line revenue growth, I think that thesis is a lot more intact. And I think the other reason the thesis is a lot more intact is because the street also believes that as well. So take a look at what Citibank said right here. They raised their price target to 625 from 590. And they said, we view fiscal year 2025 EBITDA guidance prudent and in line with the management's previous track record of guiding conservatively at the beginning of the year. That's the only sentence that really matters on this sell side report that came out this morning. Why? Because if you were listening to the call, pretty much every question was, are you sandbagging? Like, we know you're sandbagging. Are you sandbagging? Like, and freaking the CEO and the CFO, they're like, you can hear them. They're like kind of laughing. They're like, well, we're assuming some weakness because there's going to be Ramadan and there's going to be holidays. And the analysts are like, Ramadan is not the reason you guys are not going to like hit these numbers. And so I think they're trying to be very conservative with their guidance to beat and raise and sandbag. So to under promise, over deliver. The analysts pretty much figured it out. And literally in that upgrade from Citibank, they're like, we're raising our price target because we kind of know what he's doing here or what the company's doing. And we think their track record, their previous track record of guiding conservatively at the beginning of the year leads us to believe that they are going to beat on adjusted EBITDA guidance, which the street wanted 60%. They came in at 50%, and beat on top line revenue growth, which the street wanted like 23%. They came in at 22%. Most likely than not, they are going to beat. And so that's another reason why we theoretically could see the stock recover if it gets to the point where analysts stop caring about their conservative guidance. Here are the other price targets we got today. So Citi went from 590 to 625. Bank of America went from 510 to 580. And then Barclays went from 550 to 650. You got two banks that are well above $6. And you got one bank that's getting close to $6. Mark Mahaney from Evercore is also at $8. And so I guess we'll see kind of how the name reacts. Ultimately, I am not selling any of my grab. I am potentially looking to add more. I already have a lot, but if it really gives me a juicy opportunity, I'll get more. But this was not a quarter where I felt concerned about anything. I know a lot of people wanted $10 to, yesterday, and that's not happening, but that's okay. Right. And I think a lot of those people are going to leave the stock, and that's healthy because if you believe it'll be $10 in 2 years, which is not bad, that's a double in 2 years. Everyone's like, hey, Mitt, what's the next Palantir? What's the next Robinhood? I don't know. This is the best thing that I found from my research that can get me a double in 2 years. And if you have options, it can magnify that way beyond a double. And that's why I've consolidated into it. And I like it. But for those that just don't believe in the name, think there's better opportunities, then that is okay to have those opportunities as well and exit the name.